Hi, my name is Kathy Kemper-Zanck, and I'm here today to talk to you about the home equity conversion mortgage. I've been a mortgage broker or loan officer for the last 10 years. I also own a nationwide online mortgage school, and I'm licensed with the state of Oregon to do continuing education for our realtors. I do love to teach, so let's go ahead and get started and let me teach you about the home equity conversion mortgage, which is for seniors 62 years and older. The government decided that we really needed to help some of our seniors in their retirement years. When people retire, approximately 75% of all of the seniors' assets are tied up in the equity of their home. And so there was this discovery that we really needed to tap that equity to help our seniors because a lot of them weren't making it from month to month and year to year. So they've thought of this home equity conversion mortgage, and it became live in 2009. It is an FHA loan, so there is additional fees with it, and we will go over fees shortly. So in a nutshell, again, it's really tapping the equity of people's home. If people don't have a mortgage at all, we're making the equity liquid. And there's a few different ways that we can do that, and I'll go over that shortly. But I want you to kind of think about the equity like an IRA. Many of you have put, or your clients or your friends or your family have put money into an IRA every year. Then when you hit your retirement years, you start tapping those funds. Your equity is basically the same thing in a different way, a different conduit. The equity has been growing and growing and growing as you have been paying for your mortgage payment year after year after year. So when you make your mortgage payment, your equity gets bigger, and same with your IRA. As you're putting money in it, it gets bigger and bigger and bigger. Well, when we tap that equity, we can also do the same thing. We can be pulling off chunks of money out of the equity so that people can live off of it. It's really just doing the opposite of what a normal mortgage does. A normal mortgage creates equity, and the home equity conversion mortgage makes a bigger mortgage, and it makes the equity potentially smaller depending on the growth of how much values are going up. 4% is the average that we use. And yes, we can have a dip in the market, and that can affect the equity stance that people have. Let's talk about some statistics. I already told you about 75% of retirees' net worth is in their equity, but that's a much higher percentage than I ever anticipated. The average Social Security check is $1,300 a month. 2/3 of retirees are not financially ready to retire. So this is again helping that 2/3, or at least a portion of those 2/3, have some additional stability and liquidity in their life. AARP did a survey for people who already had either a reverse mortgage or a home equity conversion mortgage. They're very similar, but lots have changed in the industry when it comes to a reverse mortgage. So they actually call it something different now, a home equity conversion mortgage, because of the major changes that they made on the reverse mortgage. 95% of the people who have these mortgages are partially or fully satisfied with the financial needs that it created. 93% said that it had a positive outcome on their lives, and 94% had a much greater peace of mind. So that's huge. So options to structure, depending on your age or your client's age, your family's age, also the value of the home and the equity stance that there is in the home. If people don't have a mortgage at all, then they're going to have more options. And we can combine different options together. So the biggest one, the most frequent one, is omitting the payment in general. Then we can also, for people who have more equity, and if they want, we can create a line of credit, which is a fantastic option. If people don't have liquidity, we can put it into a line of credit. This credit line is actually interest bearing, and the interest is pretty good. You can pull off up to 60% of those assets in the first 12 months. Then you can have access to the remaining after 12 months. We can also just pull out some equity as a chunk of money. Let's say you want to pay off a car and you have a Visa bill, you have some other debt that you want to pay off, or you want to do some modifications to your home. We can just pull out the money, $50,000, $75,000, $20,000, whatever's available and what you need, and you can use those funds to take care of some of those life needs too. We can also potentially create an income stream. Again, we can do a combination of all of these depending on your age, how much equity you have in the home, and the value of the home. Fees. So the elephant in the room. Let's talk about those. They are higher. If you can kind of picture 3 different conduits of where the fees come from, it's helpful. Because it's an FHA loan, there's a funding fee. There's an FHA funding fee with even a normal conventional loan. This one is a little bit higher. It's 2% of the appraised value. And so those properties with higher values, it can get expensive, but it is a funding fee. With a normal conventional FHA loan, this fee is wrapped in. And a lot of people don't really pay attention to it because it's wrapped in and it doesn't really affect their life. This one does basically take out more equity out of your home, so 2%. There's also an origination fee. This is one of the major changes that happened. An origination fee is also based on the value of your home, but there is a cap. It's between $2,000 and $6,000. The cap is $6,000. It can't go over that. That is one thing that used to be wide open, so now it's not. And then there's normal closing costs that go with it. So you have your title, your escrow, your appraisals. You could have up to 2 appraisals with it, especially for those properties that might be a little bit different or out of the box. The lender really wants to make sure that the value is there. So they may require 2. So a few other facts and additional details about this loan. You do have to take a 90-minute counseling session, and there is a fee to that. Between $125 and $150 is quite standard. You have to be able to take that first. We have to have a certificate before we even can start the loan. Anybody can partake in it too. If you've got family members or a financial advisor, they want additional information beyond me, then that's fine too. They're welcome to partake. All the funds that we pull from the property are tax-free. And this is huge. Right now they're tax-free. It's a huge benefit. Just like if you sell your house, those funds are tax-free. You must live in the home for 6 months and 1 day, and it has to be your primary home. You can own other homes, but they can't have a home equity conversion mortgage on it. People do stay on title, and the equity is still yours. You can have other homes, like I said. You can have a second home. You can have investment properties. The types of home are single family. You can even have a duplex. You can have up to a 4-plex. So it's also a fantastic investment tool in the event you are in that situation and need to pull out money. It's still okay as long as you live in one of the units. Oh, and manufactured homes are okay too. If you end up not living in the home for 12 months, let's say you move into, or your family moves into an assisted living, you have 12 months to pay off the loan or sell the house. Property taxes, insurance, and homeowner association dues are still required to make sure that you pay those. They are not included in the transaction. Nobody can outlive the loan. It's a non-recourse loan, and the promissory note is due when borrowers are 150 years old. Everybody can live in there for the rest of their life. If there is a person in the household that is under 62, the person that is over 62 is the one on the loan. The person under 62 is only on title. But even if the older person passes first, the person still on title gets to stay in the home forever. The calculations are based on people living till 100, although when it comes to the promissory note and whatnot, that's until people are 150. Calculations are based on 100 and based on whoever is the youngest person in the house. So when does the loan need to be paid off? The loan needs to be paid off if you sell the house. When both people pass, the heirs have 6 months to do one of 4 things. They can keep the home and keep the equity, or they can sell the home and keep the equity. If they keep the home, though, again, they have to have a new mortgage put in its place and they have to pay off the current mortgage. If the house is upside down, they can just walk away. Also, if the house is upside down and they want to keep it, they can pay 95% of the appraised value. And the reason for that is there's no realtors involved. So the lender can go ahead and sell at a reduced price. So just for a moment, I want you to think about the people in your life, whether they're your clients, your parents, yourself, and think about how this would change their life. If you didn't have any mortgage payments and or you had a chunk of money put aside on a line of credit, or you had accessed some of the assets to get an income stream going or pay off some debt. So just think about that. Here's some things that people do. They may purchase another home. They can pay off any type of revolving debt, like car loans or credit cards. They can gift funds to their heirs while they're alive and enjoy it. They can hire more help around the house, whether it be for more medical help or even just taking care of the house itself, getting some upgrades taken care of, mowing the lawn, getting a housekeeper. Things like that are going to be important, and they're going to help people stay in their home longer. Omit the payment for long-term care. So this is one that we've seen happen because long-term care can be very expensive. But if you can fund your own long-term care, and potentially you won't even be using it, you can get rid of that payment, use your own funds to basically be there for that safety net that you might need down the road. Just an idea. You can also maybe afford more often, more frequent and better medical care. You might be able to parlay or omit moving into an assisted living facility. You can work on that bucket list that you still have while you're younger and healthy. The emotional security is huge. This is at the top of my list when I think about my parents. They are currently in their 80s, and I think if they consider doing this, I'm definitely going to be talking to them about it. I think emotionally, they might just be able to relax a little bit. Some people might be able to retire earlier. If we can get rid of a mortgage payment for some people, that is the difference between being able to retire earlier and not. You can reduce or omit having to work after. When you really retire, there's still so many people that have to work. Maybe you can reduce or omit that. Some people are able to parlay taking Social Security. It's my understanding that right now, the rule is you're taking Social Security, you can take it at 62. But if you can push it back to 67 or 72 by reducing your debt every month through this conduit, then maybe you can wait and then you can take Social Security a bit later when it's larger. I also think about this when it comes to my parents in taking fewer assets from other conduits. So if I can access their equity in their home, or if they do, then they can potentially not pull money from other assets and they can grow and compound and earn interest. Because this is tax-free, they can leave some of their other funds alone. And I think that that's a great tool to talk to your financial advisor about. This whole option is great to talk to your financial advisor about, and or your CPA and your family. Some people might even want to donate to charity. There's a lot of people out there and organizations and communities that can benefit from some additional assets. If you would like additional information, please don't hesitate to call or email me. The information is below. I have a one-page form that I fill out with just some basic information, and with that information, I can actually bring an entire booklet that spells out the entire scenario, from the fees to the rates, and how that would look in your future or your family's future, your coworker, your client, and we can get down to the nitty-gritty of what it would look like. So please don't hesitate. It really is a life-changing mortgage for some people, and I would love to help.